I'm Donna with Bookkeeping Made Simple. Today we're going to talk a little bit about budgets. Okay, I know, you just cringed. Budgets are just spending plans. And what I want to talk about today is really the difference between a personal or household budget and a business budget. There are some differences in the way they're treated, at least as far as I have been able to see. This really kind of came out of a conversation I had with one of my clients, who is one of my very, very favorite clients. She's absolutely wonderful. One of those wonderful people that is so positive and upbeat and happy when we talk to her on the phone that you just can't help but like her, unless you're just a really negative person and can't stand happy, upbeat people. But this really came about because of this conversation. We were starting from the idea, she wanted to create a budget for her business. And we wanted to start from the idea that when you create a personal budget, typically you start with your large liability payments, your mortgage, car notes, credit card payments, and then you add in your expenses. You know, how much do I have left over after making these payments for groceries and gasoline and, you know, meals and entertainment, that kind of thing. Well, in business accounting, it doesn't quite work that way. And that is just because of the way business accounting works. Most people, when they do their personal budgets, they're doing it basically on a legal pad or on a piece of paper, just to make sure that they're going to have enough money left over at the end of the month if they do. But in business, when I go to create these budgets in QuickBooks, and I just did one for my own company, it looks very different than what you would expect. The first thing you will notice is that your liability payments do not show up as liabilities. They don't show up on a budget that is created inside of QuickBooks. That is because rather than being expenses, like so many people believe, and I've run into that quite a bit, these are actually liabilities. These are loans that you have to pay back. You've already spent the money, now you've got to pay it back. They show up on the balance sheet. So I have had people say, you know, basically, how do you account for this? You know, can't you just count my credit cards as one big expense? And I keep saying, no, your credit card is a loan. And what you need to do then is you need to understand kind of how that works. So let's say I go to Office Depot, because I do that a lot, and I buy some notebooks or some other office supplies that I need. Fortunately, that expense is coming way down because everything's done electronic these days. But let's say I buy some office supplies and I spend $100 on office supplies in January. In February, and I put this on my credit card. In February, I pay off the credit card. Now, then I go and look at my profit and loss for February. Those office supplies are not there. They are on January's P&L because that's when I spent the money. All I did in February was basically transfer funds to cover an expense that I had already incurred. So the office supplies you purchased in January are accounted for in January, and then in February you just transfer some money. By the way, I like that way of thinking about it better for myself, because if I think of it as credit card payments, I kind of have a mental block about that. But if I think of it as, well, I just have to transfer some money to cover some purchases, then I have a much easier time with that. It's just a mindset thing. It's the same thing with loans. If you take out, I don't know, a $200,000 loan for your business, and you put that money in your bank account, you then account for it as an increase in cash and an increase in liabilities. Okay, so you can spend the cash, and those expenses are incurred at the time that you spend the cash, but you still have a loan to match the deposit that you have to pay back. Now, to see what you owe, by the way, and that goes for mortgages. I will not, it's almost de rigueur for me to just automatically, when I see closing documents for a piece of real estate, I immediately want to know what the mortgage is on it, assuming, 99.9 times out of 10, there's a mortgage. Then I want to know what the mortgage is. How much was the full amount of the mortgage? How much is the interest? I want to see all of that. And then I can figure out the amortization of interest over the course of the year. And that's a lot of big words that a lot of people don't like to talk about. But I can figure all that out for you. Same thing with the car note. If I see a new car, the odds are pretty good there's a car note to go against it. So you have an asset and a liability that kind of start out canceling each other out, because we purchased the house with the mortgage. We purchased the car with the car loan. So now we need to know where, how to budget for the payments on these things. So to see how much you owe, you go to your balance sheet. And there's actually quite a number of ways we can do that. We can create the current portion of long-term liabilities, and we can even create that month by month so that you can see what is going to be coming due month by month. To see how your payments affect your cash flow, you will need to look at your cash flow statement. This, by the way, is where I just have pulled my hair out with certain clients who had a profitable business. Their income was more than their expenses, but they kept financing and refinancing and financing again, and their liability payments were greater than their cash flow. And so they ended up, well, no, I think they are still in business, but I would have these discussions with the owner and I would say, well, you're profitable, but you're taking out these loans to cover operating expenses. And now you have an interest expense you didn't have before, and you have a loan payment when, if you hadn't taken out any loans at all, you would have been better off. It depends on your particular situation, incidentally. If you need upfront cash to continue to operate, that's a problem. But if you need upfront cash to grow, if you want to purchase, if you have a car repair shop and you want to purchase a bigger shop, that makes sense to borrow money for that. You want to make sure that what you're doing is not borrowing money to cover expenses, but that you are borrowing money to generate income. And that goes for both personal and business. Otherwise, you need to really treat your credit cards, especially as I am swiping this card. Basically, I'm going to transfer money later to cover this purchase. You're just using a different account. So if you're ready to create a spending plan for your business that includes your liability payments, first thing you need to know is you can't do that in QuickBooks. Second thing you need to know is we can help you do that so that you can look ahead and start to see where your money is going, where you want it to go. And I'm going to talk a little bit about budgeting again in my next video, because I just worked on mine and it took such a load off of my shoulders. So I do want to talk about that again. If you need help setting up your spending plan, give us a call. Our number is 801-692-0032. Or on the blog post, we have a link where you can book time with us right online. We would love to hear from you and see what it is that we can do to help you grow. Have a great day. Talk to you soon.